As we recover from one of the most unpredictable times in our economy, have you let your investment portfolio slide? We're going to get you back in the game with some investment strategies that will protect your wealth during an economic crisis. I'm Tracy Capelman. Join me right now for your Wealth Health. Hello and welcome to your Wealth Health, a show focused on helping you manage your money. I'm your host, Tracy Capelman, and I am here once again with the founder and CEO of Hilltop Wealth Solutions, Eric Brenner. Eric is a certified financial planner with nearly 30 years of experience, and he'll be providing us with some sound investment advice today. Now, this week, we're going to talk about investment strategies that will mitigate an economic crisis and protect your wealth. Our goal is to make sure your investments are prepared for any kind of economic scenario and that it will survive that scenario with the same amount of funds it had before the crisis. Now, Eric, 2020, 2021, wow, what a whiplash for the market. And we really don't know what the next economic crisis will be like. So what are some possible factors we should be considering as we're building our portfolios?
Yeah, it really was. I mean, we call it this whiplash because we had this downturn March of 2020 when COVID hit, and it was extreme, downturn quickly, and then it whiplashed back. And, that just proves that you just don't know where the market's going to go. And Tracy, I have some stats here from a recent Dalbar study that I wanted everyone to take a look at. In 2020, 30% of the investors reallocated. So those in the study, they reallocated their investments. They made a change. 28% of them actually invested additional funds. And so that was good. Invest while it's down. They said it's time to put more money in. 26% did nothing and 15% cashed out. And this really, Tracy, just goes to if people that cashed out really lost out, because it was that whiplash. It really came back with a roar. And now we're in an economy that appears by many data points that's going to be strong for a couple of years.
And it can be uncomfortable for some of us to just hold on and not cash out. I remember having that emotion, but was so glad that I didn't. So speaking of emotion, so once you remove emotion from the equation, how does somebody really go about determining their risk tolerance?
Yeah, that is an important factor. So, how they go about it is it's a feeling, but then it's also putting numbers to it. So what we do at our firm is, for new clients as well as clients that we're working with, we have discussions around what are they willing to lose? What's the dollar amount that they feel okay going down, and also what they want to gain. And we tie that to their goal. So, if somebody has kind of won the game, I call it, there's no reason really to take a tremendous amount of risk. And so we really go through many tools to help determine what risk tolerance should they be in. Therefore, they don't make these decisions that are based on emotion.
And what are some of the important factors to look at within the portfolio itself?
Yeah, so, interesting enough, investors and do-it-yourselfers feel really good when things are going up. Everyone's a good stock picker. Everyone's a good investment picker when things are going up. It really comes into level of importance when we get challenges in the market. So things you want to look at are historical returns of the investments. What's the past performance and what's that been? What are they paying? What are the fees? So if it's in a mutual fund or exchange traded fund, what are the fees? And also, are they proactive or are they passive? Proactive management means, what does those investments do? Do they buy and sell based on certain factors, or are they just passive? Do they just not make changes and act passive? And it becomes really challenging because you don't want to overreact. We just said with the whiplash market, you don't want to overreact, but it is important to kind of have a blend of both. And Tracy, on the cost. So, I wanted to really point out this cost because it really makes a difference. There's a lot of things we can't control when it comes to investing. So we really can't control the economy. We can't control the markets. But one of the things you can control as an investor is what you are paying and what the cost is. And so I have this graphic I wanted to show that shows a portfolio of beginning at $250,000 and an assumed rate of return of 8%. And you can see on the graphic here, Tracy, that I assumed portfolio on the left-hand side was 2.5%, and I assumed the other portfolio at about a little over 1%. And if you look at over 20 years, there's a $336,000 difference by doing nothing different. I didn't change the rate of return,
Wow.
Didn't change the amount invested. We did nothing different, but change the overall expense of the portfolio. And there's $330,000 more in the second portfolio over the first one. So cost really comes into play. I do want to say that I'm not saying all the time you want to get the cheapest, but you want to have a true understanding of cost.
Wow, what a dramatic difference. Now we're really getting down to the root of it all, Eric. There's also a lot of buzz around modern portfolio theory in the investment world. Explain that to us, Eric. What exactly is it?
Yeah, so a modern portfolio theory is really about diversifying your assets and achieving the most return for a certain level of risk. This was developed years and years ago, and really it's about diversifying the investments and achieving a certain level of return for a certain level of risk, and making sure that someone's not taking too much risk but not achieving that level of return. And this strategy has been utilized for many, many years. It is a good strategy. Simplified, it's don't leave all your eggs in one basket, Tracy. Spread them out among multiple baskets. So when one thing's down, maybe another investment is up. But one of the things that I wanted to point out was returns over market cycles have gone down. So if we look at this graphic, you can see that from 1990 through 2001, the overall return of a 50-50 portfolio was 9.53%. The next market cycle was from 01 through 07. You can see that same portfolio was 6.62%. And then finally from 07 through 2019, you can see that's at 5%. So we believe that modern portfolio theory over time, returns have continued to decrease, and just making sure of a set it and forget it portfolio, we think over time will have less chance of good returns for the risk you're taking. Therefore, modern portfolio theory really needs to be upgraded and updated. And that's really what we do here at Hilltop.
I can identify with the set it and forget it. I used to do that. I'm embarrassed to say, but so often we hear, and I would bet that that's not incredibly unusual, is it?
No, that is not. You're right. Set it, forget it. And, that's better than nothing. Okay. But what we're saying is that you just don't want to set it and forget it, especially as assets grow.
Absolutely. And so we were talking about diversifying. I know many people have been told to buy and hold.
Yeah, they really have. And so, what we really have employed at our firm is we really have employed a strategy that brings what's institutional type management to our investment models. Institutional management is what those big funds, the pension funds, insurance funds, and what they use as a basis for those decisions, their decisions as it relates to their investment management. And one of the real strategies that they employ is by using mathematics called algorithms. Tracy, math doesn't lie, right? The math is the math. And so, one of the things going through school we knew, right, is Either you got the equation right or you didn't, you know.
Exactly.
And so these algorithms, what they do is they really look at the math of thousands of points of the economy and determine where do we see, are the markets strong right now or not? Many data points. We partner with a third-party firm that's their name's Helios Quantitative Research. This is a firm that we partner with that helps provide us proper data and information to be able to help provide to the clients. And we make changes to this. So Tracy, think about this. Think about a dial, like a dimmer switch on a light. When it's time to dial up, meaning that maybe we take some more risk within your risk tolerance. People want to make more money when it's time to make more money. They also want to protect, right, when it's time to protect. And right now, as we've taped this, the economic indicators and the algorithms say, look, it's time to dial up here. We could have some real good economic growth over the next couple of years. And that's the difference from the buy and hold and do nothing.
Wow, this is such good information for our viewers. Eric, some people think that they can just run their own investment strategy. And I mean, it really sounds like, gosh, you could use the professionals' helps.
Yeah, they do. And, one of the things that I think that can be done, and as I said, when things are going up, it's real easy to think that you have the expertise and you have the experience. But here's what I say is that, a 10% market swing on $10,000 is $1,000. A 10% market swing when someone has $1 million is $100,000. So mistakes get very expensive. And if they're not basing it, and think about this, there are folks out there that live, eat, walk, talk, breathe investments. And one of the things by us utilizing algorithms, we really didn't want to be giving advice to folks in getting direction on just a feeling. Well, we feel like the market's going to go up. We feel like this is going to happen. We wanted to base it on facts. And so really doing it yourself and how to distribute money while doing that. So in other words, how to take money in retirement, it gets very complex pretty quick.
That's right. The numbers are the numbers and you need the numbers. So Eric, for just a second, let's dissect long-term versus short-term compound rates. In what ways do they differ?
Yeah, so long-term compound rates is really what we focus on, and that is compound over time. So that includes the good and the bad returns, right? So not every year is going to be up. So that includes the good and the bad, and it looks at, okay, over a longer period of time, what has those returns been? I shared that graphic a couple minutes ago about those market cycles, and we've seen that those returns have gone down. Well, that's really in a portfolio what you want to focus on is what is the long-term compound rate? A short-term simple rate, what happened last year? What happened this past year? What happened this past 2 years? Really does not come into play as much as a long-term rate. And so that's why historically you need to look at what have the returns been over that period of time, because that's really what's going to matter to really build true wealth in a portfolio.
And can you tell us what the main benefits are of the long-term and short-term rates?
Well, the short term, I don't know if there's a benefit. It feels good that the markets went up and your accounts went up a lot during that year. But it's also what did you lose when things went down and how much went down? And did you lose more than what you should have? The long-term rate, again, it's compounding. So I call it the miracle of compounding. So, it is this kind of compounding effect. And if your long-term compound rates are even 1% higher, it makes a huge difference as it relates to the amount of money over time that someone can not only accumulate, but also live on. And it equals income. So it is long-term compound rates really is a big factor.
And what types of financial situations might fit each of those options?
Yeah, so really a financial situation, whether it's short term, so a goal that's short term, whether it's other financial goals that someone has or longer term goals, it fits each of those. So we really have to bucket short term, midterm, and long term goals. That's really where we come from. And then therefore put a risk tolerance that is comfortable, tie that to one situation. And over time, then we get this long-term compound rate.
Awesome. Eric, you have certainly given us a lot to think about in regards to the importance of really carefully assessing your risk tolerance and implementing that right balance of investment strategies to survive an economic crisis like this one. And certainly these decisions shouldn't be made lightly. So here's another question for you. Suppose one of our viewers has a portfolio of investments that they're not sure is right for them and they want a second opinion.
Yeah, so what we can do, and we want to offer up this no cost risk assessment. And what they can do is they can call the number there on the screen, that 633-1476 number, or they can go to our hilltopwealthsolutions.com, our website. And what we will do is we'll take a look at and put into very analytical software their portfolio and really come up with a risk score, a risk number. And oftentimes, Tracy, one of the things I want to point out is that oftentimes people have little pots of money. They have their retirement plan, other pots of money, maybe a couple different accounts spread out, and they're really may not be working together. So it's really kind of working against each other, and they could be overweighted somewhere. They could be taking more risk than what they think they could take. So we have the ability to really take an assessment and determine what their risks are and really dive into what they're paying, what their costs are, and determine if it's right for them and their situation.
Thank you so much, Eric, for that valuable offer. I'm sure it's going to come in handy for many of our viewers. Now, when it comes to taking financial risks, you really can just never be too careful, can you?
No, you really can't. I mean, you want to make sure that, hey, I'd say this all the time, is that we are more responsible for our future than ever. And so you just have to be cautious and make sure that you're making good decisions, and things continue to get more complicated, not easier.
That's for sure. Well, thanks so much. We are out of time for this edition of Your Wealth Health. For Eric Brenner and the entire Hilltop staff, I'm Tracy Capelman. Thank you so much for watching. We'll see you next week. Until then, stay wealthy, everyone. We hope you found this discussion helpful today. Don't forget to like and subscribe to our channel for new content weekly.